How are you doing? What's your outlook of the markets for the moment?
Die Stummschaltung ist aufgehoben.
Good morning, Alex. Good morning, traders. Thanks for the nice intro, and welcome to all new traders, and of course, welcome to all regulars. Very appreciative of you guys coming in. Let's dig into the week by first having a quick look at what last week brought. Quick question, can you hear me okay? Can you see the screen okay? Are we good on IT?
We are fine.
Excellent.
Perfectly fine.
All right, Bob, thank you very much. Here we go, off we go. Last week we were looking at the opportunity to long the pound versus the Swiss franc. Now I chose a conservative entry at the time. Why? Monday morning is usually when some of the larger institutions on the swing trading side plan for their weekly, we call that a campaign, for their weekly campaigns. So Monday is basically the construction day. We position ourselves, especially if there's no tier 1 data, it's all about grabbing liquidity, trapping less informed traders into the wrong side of positions by causing them to hit the button when it looks like a breakout is occurring. For the new traders, if you want to do yourself a favor, do not learn how to breakout trade. Do not learn how to breakout trade. It's the worst thing you could possibly, in my personal experience, do to your brain. Much rather have you guys start out by jumping on an established trend on a pullback. That would be much easier. Yeah, breakout trading is used by institutionals to get liquidity off of less informed traders. So what happened? We didn't get the pullback, but we had what we call a top right hand hold. We had a break, a hook, and then a go. So fair enough. Profit target was reached. But for the purposes of the Monday morning weekly meeting, this trade obviously was not reached. Well, it is what it is. That is the drawback for those traders who cannot sit in front of the screens but have to go to work somewhere else. You may miss some trades. Doesn't matter. It is what it is, right? Pound versus Swissy, no trade. So headlines overnight, we had risk on sentiment. We had a very strong equity close into Friday night. And then typical for, I recall it from the global financial crisis, Sunday night before the futures markets would open up again, we would see that positive news were pushed into the market. And we had the same occurrence with Trump last night, where he started tweeting about the great deal and progress being made. And I can see now why a lot of German clients of ours do not like my Americanized, exaggerated tonality and way of expression. We can really have this tendency over there in the States to call everything great and lovely and awesome. And I can now see Trump is mirroring this to me, how annoying this can be to more conservative Europeans. So I'm going to try to work on my communication skills as well. So we had US-China trade talks supposedly progressing. I tweeted a really interesting video clip. It was in the Oval Office. It was the senior rep from China. It was Lighthizer, and it was Trump. And they were talking and arguing in front of the cameras and the journalists about what a memorandum of understanding was. Super interesting. Check out my Twitter account, have a look at it. It will give you a little bit of an inside gauge of how high emotions are running, how difficult it can be to work for a character that Mr. Trump seems to be exhibiting. Obviously, I'm not a psychologist, but it's quite interesting to observe. March 1st trade deadline is extended. Please recall that Trump already incurred tariffs in the amount of 10% on 200 billion of Chinese goods imported into the US. Also, please recall that it is US companies and i.e. US consumers paying those taxes. I understand that he keeps tweeting, at least I saw it personally twice, that Chinese are paying billions in tariffs. That is not the case. The truth is that US companies trying to get their products that they're importing, they need to pay the tariffs at the harbors when they get their products out of the customs offices. Yeah, so it's the consumer and the U.S. companies paying for it. The deal was, or the threat was that if there's no trade deal by March 1st, Trump would increase these 10% tariffs on 200 billion of products to 25%, and that is currently being extended. That's why we had the risk on sentiment. Now in Asia, you saw that the Australian stock market increased by 30 basis points, the Nikkei increased by 0.5%. But the real kicker was CSI in Shanghai, 6 and 5.6% up. So there was the good news really priced in. On the CSI side, it was the biggest daily gain in the index since July of 15. The Hang Seng, on the other hand, had a muted reaction because the utility sector was depressed because there's a large utility stock that may be delisted. So if you see discrepancies like this, again, for the newer traders, the question is always why? Why is everything rallying, but the Hang Seng is not? And then you dig in and you find out. The renminbi, i.e. the yuan, was appreciating by 60 basis points to a 7-month high, and the Aussie dollar obviously also benefiting from this, we're increasing 0.5%. We'll get to that in a bit later. Please, please, please treat this risk on rally carefully, though. Why? Because I don't know how to pronounce this. Xinhua is a Chinese news outlet, and they reported that the trade talks are set to become more difficult at the final stages, which is completely obvious. So please, please, please do not go all in. I'm not saying that you're doing that, thinking, okay, this is the end of all, and I want to front run the rally. No, economic data is coming in weaker globally. Global growth is coming off. We are not in a situation where we are in a bull market. Typical for bear markets, you have vicious risk on rallies as we are observing right now. I am not switching my bias from bear market to bull market yet. Why? Because I'm data driven. If the data changes, I will change my mind and my positioning so quickly you can't even look at it. But for now, I play very conservative in terms of bear market. So I'm, for example, long duration, long-term US Treasuries. It's one of my core positions at the moment. Prime Minister May, once again, delayed the meaningful vote, and that is causing, I read this morning on Bloomberg, 100,000 UK businesses headache because the uncertainty is getting prolonged. She's playing the game of chicken masterfully now. So the question is, who will blink last, the EU or the UK? By pushing out her meaningful vote, she's trying to get to a last-minute forced decision by her House of Commons to vote her Brexit deal in favor of. Very dangerous game. Again, UK economic growth has been suffering of late, due to the uncertainty. UK businesses are having a very hard time investing and making plans for the future and transacting in business. There's tons of articles on the net. If this is of interest to you, I suggest you read some of them so you get an understanding of the difference between the markets and the real economy. Okay, now if there's a last-minute deal and or a delay that could be causing temporary pound strength, long-term not so positive because the uncertainty would be prolonged. So Brexit is to be delayed for up to 2 months under plans being considered by May in a bid to avoid resignation by ministers. This is according to the Telegraph. So also always take it with a bit of salt, a grain of salt. Some of these headlines are actively used to manipulate the positions and markets. Let me repeat this. Headlines are actively being pushed out to manipulate the markets. EU now has an incentive to delay as well beyond March 29 deadline. Why? Because if they miss that, then the UK stays in the bloc until 2021. This is good for the fee payments, and this is also good for representation in the EU Parliament. Personally, again, it's nothing to trade, it's my personal opinion, I would love for the UK to stay as someone from living in Germany, because They are a voice of reason when it comes to all these insane socialists in the EU Parliament, right? So it would be terrific if they were to stay. And I'm not convinced, I keep repeating this on a weekly basis, that they will leave. We'll have to see about that. The Kiwi, last note here on the headline front, gained overnight because retail sales came out strong for the fourth quarter, and that eased some of the concerns for softer growth in the New Zealand economy for now. Very nice slide from Bloomberg this morning, where it actually exhibits that a delay, i.e. this uncertainty within the market, would hurt further growth of the UK economy. So it's too simplistic to say, hey, they're extending Article 50, or hey, we have another, and this is, by the way, realistic. It's 2019 now. Zero agreements are in place, right? Even for the UK to get trade agreements in place. I said this a few months ago. Let me repeat this right now. We had a very, very high level consultant at SocGen, the last bank where I worked for, and we took him to clients, and the whole purpose of he was 5 years in Parliament in Brussels, had his own hedge fund, yada, yada, yada. Very high level connected guy. And he stated that on average for a country to come up with trade agreements takes 10 years. 10 years, all right? Next to the fact that Brussels is doing most of these trade agreements for the EU members. So there's an army of lawyers in Brussels doing that for EU members. The UK didn't even have this army in place. They're still in the process of hiring lawyers for trade agreements after a potential Brexit, right? We'll have to see. Again, temporary strength may occur. But then again, uncertainty means pound weakness. Markets hate uncertainty. They absolutely hate it. Picture overnight, as we can see, we had Aussie gaining and then yen weakening, typical risk on scenario. And this was based on the US Sino tweets. Risk events for this week. We only have a few slides, but we have 2 slides for the dollar because it's important for me to show you guys what's going on within the Fed. We have a very interesting situation in the Fed. They're going to revisit for the next 6 months their monetary policy stance. Not only the stance, but their methodology. And it's of crucial importance to us to always, always, always get our own view of the dollar. Dollar being part of almost 90% of all global transactions means if you get the dollar right, you get every other asset class right. Or mostly right, and that is of importance. So Clarita said, she's a voter and neutral, that the Fed is launching a broad review of the policy framework. I just said that. Mulling changes to inflation targeting framework. This is super interesting because last night, I mean to us, I don't know if you find this interesting. Last night, the Japanese, they actually said, you know what? One of the advisors to the Bank of Japan stated last night on the wire that why don't we get rid of the 2% inflation target? It's not necessary anymore. Super interesting. Google Amazon effect, and you'll know what this is all about. Amazon effect. All right. So now the Fed may be mulling to changing their inflation targeting framework. They may consider new tools to ease policy if needed, such as, attention, capping treasury yields. Exactly what the Japanese are doing. The Japanese are not only controlling the short end of the curve, but also the 10-year bucket by stating 10-year yields are 0. They have a band of plus minus 10 to 20 basis points, but basically 0 to 10 years is flat in Japan. 0, nothing, i.e. short and negative rates, obviously. Quals, voter neutral, said he probably underestimated the difficulty of communications on the balance sheet. Yeah, no kidding. Thinks balance sheet should move to shorter maturities. Interesting. Very interesting, because that means that we have an artificial bid on the short side and the bid drops out of the long end, which could then imply a steepening of the curve. That would be good for financials. Added that it is appropriate to keep the balance sheet large enough to buffer against shocks to reserve supply. That is ultra important and super difficult to explain and cannot be done in the morning meeting. Yeah, reserve requirements of the central banking system. So the Fed has a constraint to how low the balance sheet can go based on that. And one option of ending balance sheet runoff this year is to hold a fixed level of total assets for a time. Interesting. So there's much going on within the Fed, much going on. Bullard said does not want policy tools at cross purposes, doesn't want to cut the balance sheet and rates at the same time. Okay, that is cutting the balance sheet is actually stimulating the economy, and increasing rates at the same time, cutting the rates at the same time is also stimulating. So he says we shouldn't be doing both. Okay. Added that now that rates are higher, changes to the balance sheet will only have minor impact. I'm sure they are going to publish research on that shortly, or probably they've already done it and I missed it. Harker says quantitative tightening should end in 19, says slow and steady approach will reduce uncertainty, added that the Fed should be cautious with balance sheet wind down. Okay, so why am I showing you this? They're tilting from hawkish to neutral, and the next step will be from neutral to dovish. Meaning the short end will come off, meaning equities at the top edge will realize, shit, this is not even positive, meaning equities sell off. Very simple. Powell will deliver a semi-annual testimony to lawmakers this week, all right, on the 26th and 27th, and the market will focus on commentary on balance sheet normalization and the approach to lifting rates. What is the market pricing in? That is of importance to us. Recent Fed meeting minutes were net neutral, and the market, now here it is. US surprise indices and GDP trackers have been heading south. Market currently prices an 83.8% probability of no rate move whatsoever in 2019, and 11.6% for one rate cut and 4.5% for one rate hike. If this shifts down or up, accordingly, the dollar may shift along with it. Okay. And then Fed's projections will be updated at the March meeting. This is of importance because currently the market is looking at the Fed's projections from December. And recall December, we had this market sell-off. Then we had this vicious recovery in January now. So all eyes will be on March update. What are you guys expecting of the economy going forward? And then this short-term money market will react to it accordingly. And then the dollar will react accordingly. And that will give us a basis to trade everything else. What do we have going on in econ numbers this week? So on Thursday, we have GDP, horrible, coming off to 2.6% versus 3.4% in the third quarter. Recent economic data was to the downside. Only labor market data remains strong, super strong. And then we have Atlanta Fed GDP now modeling, but also some of the other Fed models. They're all tracking lower, including all of the investment banks. I haven't seen a single investment bank of the big ones who haven't tracked GDP growth lower for the fourth quarter and lower for the first quarter of this year. So GDP now, Atlanta Fed coming in at 1.4%. Yeah, market pricing in 2.6 for this number on Thursday. Why? We had soft durable goods data that goes into the GDP, and we had a massive retail miss on the retail data. On Friday, we also have ISM manufacturing, and that's expected to come in a little bit lower. Now, last time when we came in at 56.6, it stated the overall economy grew for the 107th consecutive month. We had 9 consecutive quarters of GDP growth. That has never occurred in the history of U.S. economic growth ever, or the U.S. economy ever. We have exports continue to expand, but at the lowest level since the fourth quarter of 16. Of course, that is the impact also of the trade war. And inputs and prices indicate fundamental changes in supply chain constraints. That is correct. Supply chain is being constrained also due to the trade war. Only industry reporting contraction in January was non-metallic mineral products. So for all of you equity traders out there, you go into this sector, non-metallic mineral products, and you look at the weakest equity you can find, the weakest stock, and you short the shit out of it. That's basically how you make money. What do we have in Canada? We have Wednesday CPI expected to come in a little bit stronger, but the year-on-year is supposed to be coming off. Difficult, right? So what's of more importance? We will see based on the market reaction. Gas prices, airfares, and food prices have all fallen. Hence, the inflationary pressures cooling. CPI basket weights have been changed and a new methodology for household rent has been introduced. And household rent makes up 6% of the CPI basket. So that's of importance for all of you data crunchers. Dig into it, find out what has changed if you want. Friday GDP flat versus a slight contraction last time. Year on year expected to come in at 1.1% yearly growth. And that would be the second below trend quarter in a row. I like the Canadian dollar. I like the Canadian economy. It's to me the second strongest currently after the US economy. And I've liked the Canadian dollar long, especially given that oil has been recovering nicely. But now I need to keep an eye on data, just like the Bank of Canada does, because if it starts cooling, as it does in the US, and both economies are highly correlated, that could incur some weakness for the Canadian dollar. And I saw one investment bank already recommending long dollar CAD this morning for this week. Obviously, it makes no sense to me, that trade at the moment, because I'm not playing weakness versus weakness. Household consumption is likely to be weighed on by higher interest rates. That is obviously a factor. Sorry, and I just wanted to point you towards these slides here. Canadian inflation coming off. Do you see that? Let me see if I have a drawing tool. Yeah, I think I do. So from July 18, we're coming off, and similar in terms of GDP growth. Now, last time we came in 2.1. If now on an annual basis, year on year, we come in at 1.1, that's a similar horrific scenario as we have in the US. So we're looking at that because I want you guys to be careful when you have equity, i.e. stocks, start hedging, start being vigilant about your long positions and don't get sucked into this bear market rally. Trade this morning for this week. Well, maybe you guys agree or don't agree. I like a long Aussie dollar. One is a pretty swift and quick trade, and the other one is the one that I like better. And let's dig into it real quick. The Aussie is benefiting from risk-on sentiment if this China trade talk with the US continues well and progresses positively. Also, towards the latter part of the week, we have good economic numbers that are expected on Thursday. So that could be a beneficial driver for the Aussie. For the dollar, on the other hand, we have good trade talks, meaning risk-off flows would leave the US dollar because a lot of money went into the US dollar based on risk-off, not into the Japanese yen, not into the Swiss franc, but into the US dollar. So those flows would be reversed. Also, we have weak economic numbers towards the latter part of the week. So I like the trade better towards the latter part of the week. The risk to the trade is obviously that they mess up the trade talks, which is, attention, not unlikely. It is not unlikely that Mr. I exaggerate even more than J. Donald Trump comes around and messes this thing up. All right. So trade number one is the first pink one, is long 71.50, which is right here below the POC. My traders know why. Take profit is the 72 and very tight stop loss, 23 pips. Right underneath here. Well, actually, it should be a little bit lower. So make that a little bit lower, maybe drop it down to 17. Yeah, that drops down the risk reward a little bit, but who cares? The one that I like a bit better is for the market to come off and potentially hit this massive liquidity down here where we have several former POCs. So long the 71, the figure, same target at the 72, and then the stop loss below the swing here, right around 70.43. Again, I like this trade better because it's more conservative, but I wanted to give you guys an aggressive one as well because we missed the pound versus Swissy last week because I was too conservative. So now you can make up your mind. By the way, you shouldn't be trading these at all. This is just to show you the development of a trade based on a fundamental/institutional process. That concludes today's Monday morning meeting. You guys have, hey, VT, do you guys have any questions? No? Okay, good. Then I hope you make some money this week, make some pips, and see you all next week when we continue your education and our process of making money. Thank you very much. Thanks, Mohammed. Thanks, Marios. Have a great trading week. Marcus, get well, my friend. Michael, be good. Sigrid, I'll see you all for our webinar tomorrow morning, right? Christina, bye-bye. Have a good one. Ciao, ciao. Alex, you can switch it off, mate.
Okay. Thank you very much for your comprehensive analysis, Jay. Thanks to the audience for listening. I hope you enjoyed today's webinar. If you did enjoy